Hey everyone, welcome back to our monthly market commentary. I'm Brad Gatto, owner and founder of Fiat Wealth Management. As always, here with my buddy Tim Holland, the Chief Investment Officer of Orion and Town Square. Tim, welcome back to our monthly market commentary. Thanks for being here, man.
Thanks for having me on, Brad. Always good to see you. Hope you're doing well. Hope the family's doing well. And I think, at the risk of throwing myself under the bus, I thought April was going to be kind of a quiet month. Not a lot's going to go on in April. So I just figured I'd rip the Band-Aid before you did. So I got that one wrong. But knock on wood, May's off to
You know
a
what?
decent start. But it's
Let's
good.
focus
It's
on the
always,
positive. Let's focus
yeah,
on the positive. You
always
got a
good to
fresh
see you.
haircut. You're looking great.
Right?
And
I'll
so we
take
should
that.
probably just schedule this after your haircut every month.
Okay.
Um, and two, living in Minnesota, the Twins won 12 games in a row.
Yeah.
The Timberwolves haven't lost a game in the playoffs yet. They're taking
And they're
down the
up
mighty
two,
Denver
two,
Nuggets.
2-0 on the Nuggets, right?
Yeah, as we record this, that was last night that they played game two, and it wasn't even really a game. They just kind of ran
Yeah.
away with it without our center, Rudy Gobert, celebrating the birth of his first child. He didn't even
Oh, good
play.
for him.
So
Yeah.
lots of positive. April and the returns in the market, not as positive.
Not as
But we'll
positive.
talk about that and unpack that a little bit. If you're new to the monthly markets commentary, our standard procedure here is we're always going to have 3 points that we discuss. The first point is always a look back at what happened over the last month. The next point is going to be a look ahead at what's coming up this month in May. And then finally, kind of a data point worth discussing. So, Tim, here we go. I'm going to put you on the spot. You already kind of put yourself on the spot. I love the accusation audit. Like you're not going to let me call you on the carpet if you just, call out your flaws before somebody else does.
12 years of
I mean,
Catholic school. Yeah, no,
yeah,
and
yeah, yeah,
I'm
yeah.
not, yeah, I'm not looking to offend anyone. I'm a good Catholic kid, 12 years of that and the nuns and everything else and Irish Catholic guilt. And yeah, I'm coming clean straight
Okay,
away. So
we just went from monthly market commentary to a very deep,
very deep.
uh, what's the word I'm looking for? Therapy discussion here that you need to have about
Yeah,
your
for
12 years
sure.
in Catholic school and
Oh
Irish
boy.
Catholic
You,
guilt.
you got that one
You
right
had,
for
you had the
sure.
nuns, huh?
Oh, yeah. Oh, and here's the thing. I'm old enough, even with the fancy haircut. So I'm in my mid 50s. So I went to Catholic school in the 70s through the 80s. And at least in New Jersey at the time, the nuns, without getting into it, could still hit you.
Yep.
So yeah, I mean, this is kind of, it wasn't super old school, as they say, but it was pretty bars
Yeah.
of soap in the mouth for swearing, the whole,
Yeah.
yeah, it was intense. So anyway.
Dare I say it worked?
I guess, right? I
Yeah.
turned out okay, I think, I hope. We'll
My
see.
uh my dad went to a Catholic school growing up, and he's got some stories
Oh,
with the
I'd,
nuns.
I'd
He's got
like
you by about 10 years, my dad does.
I'd
So
like to spend
same
some time
stuff.
with your dad and swap some more stories
Yeah.
for sure. Okay.
There's a couple that involve yardsticks.
Yeah, yeah. Yardsticks,
Anyway,
paddles, and erasers flying
okay.
across the room. All right, I'll stop.
So now that everybody feels bad for you and you already did the accusation audit on yourself, I'll look back. I always name these points. There's a couple here that are a bit of a stretch this month, but just hang with me here, okay? So I'll look back. The point is slow, fine. High, also fine. Slow and high, not fine. And what we're talking about here is obviously we had a bad month. The S&P was down 4.1% in April. Obviously, those aren't the only stocks out there, and that doesn't define the entire economy, but it's a benchmark people love to follow. So that fell 4.1%. So really, I think the question on a lot of people's minds is it here to stay? Is the declining market here to stay, or how do we recover from this? And so what I'm talking about with slow and high is slow economy and high inflation. Slow economy, we can probably stave that off. High inflation, maybe we could stave that off. But the combination of those two could spell something negative or disastrous. And so talk to us a little bit about April, kind of what happened in April, and then how these two things in tandem might continue to pull the markets down.
Yeah, no, I think that's the right stuff to focus on, the right stuff to think about. So if you go into April, which to your point was a tough month for U.S. equities and not just the S&P, but most folks focus on that index. You had a March CPI print, Consumer Price Index print, which was the third consecutive print, and it's an important inflationary gauge that surprised to the upside. So after all this
Yeah.
progress on inflation through year end, things kind of started to go the wrong way. Then you had a Q1 GDP, gross domestic product print, that came in lighter than expected. And all of a sudden, folks started to think, okay, the economy seems to be slowing a little bit. Inflation's proven to be a bit more persistent. And that's a really tricky combination. It kind of goes back to the 1970s, the stagflation era, which was a tough decade for the U.S. economy and U.S. equities. And so I think folks started to worry that, okay, the Fed can't cut because inflation's proven to be a bit too persistent. And then at the same time, maybe the economy is struggling a little bit. And then what happened, I think, not to get ahead of ourselves, coming into May, and it's been a pretty good month so far. The S&P again is up 3%, almost recovered everything it gave back in April. On Friday, you had the April jobs report, which was pretty weak. And I know we already talked about a slowing economy, but it was so disappointing relative to expectations that all of a sudden folks started to think, okay, if the labor market's finally softening, that means wage inflation will continue to come in. Those final kind of pockets of persistent inflation should start to really crack if the labor market's really softening, which means we won't have to worry about a slow economy and high inflation. It's most likely going to be a slowing economy and still dropping inflation, maybe back on a path to a mild recession, which won't be great for Main Street, but opens the door to the Fed to cut rates this year, lower bond yields, and now the market is pricing in 2 rate cuts later this year. So falling inflation, falling GDP, the market's going to be okay with. And I think that jobs report last week shifted that inflation dynamic in a big way. And that's why stocks have rallied and bonds have rallied the last 3 days, I think.
Yeah. I liken it to, it's almost like anything in life, anything that's good or great, there's always some sort of pain you have to go through to get it, and the best things in life are the hardest things in life. And so none of us want inflation. We don't want to pay, we're all feeling it at the grocery store and at the gas pump and in other places.
Yeah.
But in order to get that under control, we have to slow the economy down.
Yeah.
When you slow the economy down, depending on who you are and how you interact with the economy day to day, can also have a negative effect on you. So it's almost like you have to rob Peter to pay Paul a little bit. You can't always have all the good. So as disappointing as it might have been that the jobs report wasn't there, the silver lining, if you will, of not eating cupcakes, which that's bad, is I might lose weight, right?
Yeah.
So it's going to be interesting to see how it plays out. I mean, it's been through the first 4 months of the year, kind of with the way the year started. If you go back and watch our December to January market commentaries, everything has been so centered on this interest rate environment and what the Fed is going to do. And we can't seem to land really anywhere, at least get it's like right when we got the Fed and the markets on the same page, we're like, okay, we're both good at 3 rate cuts. That is, then all of a sudden we get this inflation comes in a little hotter and it's like, well, but maybe we'll settle somewhere that feels pretty good. So
and I think it's important to try not to get too caught up in the month-to-month data, because to your point, it's been all over the place. The back half of last year, the inflation prints looked great. Everyone thought the Fed was going to cut like crazy. The Fed said, take it easy. Then the inflation data didn't look great, and everyone's saying the Fed can't cut. And the Fed even said, we get it, but take it easy. And then you get the jobs number, which is kind of reset expectations around. Again, inflation should come in. The economy should weaken. Some people, unfortunately, will suffer from that. But you've got the door open again to 2 rate cuts, at least as of now, later this year.
Yeah. Awesome. So let's talk a little bit about our next point. Point number 2 is a look ahead. What is coming over the next month? And so the name of this point, and I'm just gonna admit right up front, I am not a soccer guy. Okay. No. I don't follow soccer. The crux of my understanding of soccer is Ted Lasso. So that being said, the name of this point, and so that disclaimer is if I butcher this, there's a reason, is Aussie, 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 oi, oi, oi. That's a soccer chant.
That's good.
And if that's not it, it's something similar to that. But I'm going to focus
on
the
oi. It sounded legit to me, but I know probably less about soccer than you do. But I thought it was wonderful.
And pre-recording, we were arguing about different idioms and who was right and who was wrong. So I don't know that either one of us has a leg to stand on here.
I don't.
But I want to focus on the oi, oi, oi part. OYE. And oi, oi, oi is an acronym, which is oil, yields, and earnings. So as we look ahead,
Yeah.
what are we looking at? Well, those three things: oil, yield, and earnings. Why are those the three things that we should be paying attention to right now?
I think at a high level, they're going to be, they have been and should be really good guideposts for the Fed and the Fed's attempt to kind of stick that soft landing, right? Soft landings are kind of like unicorns, they're not often seen, where you can slow the economy enough where you don't put it into recession, but you put that inflation genie back in the bottle. People felt good about that back half of last year, not so good the first 3 months of this year. Now they're feeling a bit better. So if you think, especially with the geopolitical dynamic as it concerns oil, when Israel and Iran attacked each other directly, which had never happened, the price of West Texas hit $86 a barrel. It's back down to 78. I think if oil prices can stay in that kind of, high 60s to low 80s range, sort of move sideways, you take away one potential source of an inflationary spike, and that creates space for the Fed. That ties back to yields, and the yield on the US 10-year note, which is arguably the most important financial instrument in the world. It hit over 5% last year, finally peaked, came in through the end of the year, and markets really, really rallied. But then as we got through the first quarter and inflation pressures started to present themselves again, it ran up to about 4.7%. Today it's at 4.4 and change. So it's come in the last couple of days, stocks have gotten a bid, bonds have gotten a bid. So everyone's really laser focused on yields. We're kind of thinking, at least our team, that 5% was the peak last year, and the path is still lower. If that proves to be the case, it tells you that the bond market, I think, is also not sniffing out that inflation pressure coming back, which is going to be a real problem for the Fed. So those are kind of really important from the inflation end of things. And then in terms of the economy and that soft landing, you want to see some earnings growth. It doesn't have to be spectacular, but if you can get to sort of high single-digit growth for the full year, that's a nice combination of 1% or so GDP growth, moderating inflation, a couple of rate cuts. It is a classic Goldilocks scenario, but I think it's possible. I think it'll be sort of on the table, off the table, depending on the monthly data. I think it's possible, but those are the three things that we think ultimately will tell you if there's that runway for the Fed to come in on or not. And I think it's only a couple of days, but the last week or so, that runway is presenting itself again. So we're paying a lot of attention to oil yields and earnings for sure.
So it goes back to point number one. We're looking at the economy and we're looking at inflation. And when you look more specific at those generic terms inside of inflation, key indicators could be oil and also bond yields. And then on the opposite side, when we're looking at the economy and kind of the growth or lack thereof, it's going to be these earnings. And so in watching these things and thinking, gosh, maybe they've done it. Maybe the Fed has given us this soft landing. That can be, obviously, that's going to be an extremely important, not only in the short term, I would say in the mid to long term as well for our markets. I mean, I don't want people to lose sight of this. If this soft landing happens, 20 years from now, they're going to be writing books about, as you call him, because he's your best friend, Jay Powell, right? I'm like you said, this is not, if they can figure out how to slow this whole thing down and not crash the economy at the same time, really, really tough task to do. So when we're watching these things, you made the point earlier, and I always end, I don't want to give away the ending here. I usually end with some sort of long-term anecdotal, hey, we're talking about it monthly to kind of him and haw about this. But at the end of the day, if you're an investor, it's a long-term game. But in the long-term game, this is a huge deal. And it's very, very hard for the Fed to do. But we're this deep into it, and there is a chance it could happen. Like there is a possibility. There's still like that called third quarter, fourth quarter. We're deep into the game. And there's a vision for this working. And so that in and of itself is positive. And I take that as a cup half full, the fact that you and I still get to talk about the opportunity or chance that the soft landing could happen. So
well said.
Awesome. So a data point worth discussing. I'm calling this one 13 for 13. I don't care what sport you want to relate that to. 13 for 13 is amazing. And anything that you do in life, what I'm talking about is we've had 13 presidential elections where we've had an incumbent vying for a second term. And in all 13 of those election years where we had an incumbent, of course, in this case, Joe Biden, vying for a second term, the S&P was up in that year. Now, does that guarantee it's going to happen and we're going to be 14 for 14? No. But man, is that interesting. And not only was it up, 15.8 is the average. What do you think's going on there? I mean, is it just a coincidence or is there something there?
So right, this correlation, causation. I think if you want to lean on the causation end of the argument, it's whoever sits in the White House. And what's interesting is of those 13 elections going back 80 some odd years, the incumbent didn't always win, right? So you had George H.W. Bush in 92, Ford serving out Nixon's second term. He lost to Carter and so on. But the markets were still up, regardless of whether or not the incumbent was successful. So I think from a causation perspective, and I'd argue we're seeing this right now, or we have been seeing this out of DC, the incumbent is going to do everything they can to juice the economy, right? Yeah. And so if you think about the Inflation Reduction Act, the CHIPS Act, some of these other things that the administration did when the Democrats, before the midterm, when the Democrats had the other end of Pennsylvania Avenue, a lot of that spending, those grants, those tax credits were sort of loaded to hit in 2024. One could argue that's pretty good timing if you're going into an election, not to be cynical. So I think part of it's that the incumbent is going to do everything in their power to get the economy going in the right direction. And then there are other things that the Treasury Department can do in terms of liquidity, the banking system and the like. So I think if you had to lean on causation, it's that. Correlation, it could just be a bit of luck. But considering, it's probably going to be a pretty volatile summer, fall with the election, even if politics shouldn't impact the markets, it would be naive for me to think it won't impact sentiment and some behavior. So I think as we go through that, I like to keep things in my back pocket when the world gets a little scary that I can kind of lean on, and usually it's market history. And I'll take 13 for 13 as we go through 2024 and get closer to election day, and especially with a pretty nice start to the year as well. So that's how I would think about it.
Yeah, I mean, it's just interesting. The reason I think it's so interesting is I think if you polled 100 people and said, this is the 14th time that we've been in this incumbent vying for a second term, of the past 13 times, how many times do you think the market was up? I don't think anybody out of 100 would say 13 out of 13.
Yeah, I think you're right.
Not only that,
pretty wild.
If they had to guess the average rate of return in that year, that it's 150% higher than the historical average. On top of it, it's an interesting stat.
Yeah, I agree.
Now, as much as things stay the same, things change in a lot of ways, or as much as they change, they stay the same, however you want to look at that. And from a political perspective, we all know that it seems more divisive than it's ever been. I think a lot of that just has to do with flow of information and how much information is out there to know. But I'll just end by saying this. Broken record, always going to be a broken record. We don't invest in election cycles, right? If you're going to invest, you got to stick around no matter who is in office. Because if you look back at market cycles, there's not a ton of correlation to the left side of the aisle or the right side of the aisle, and you should always be in when it's on the left and always on the out when it's on the right, or vice versa. The markets behave based primarily on economic data. So long story short, we've gotten the question a lot here at Fiat. Is there anything special that we're doing because we're coming into an election this November? And the answer is no. If you're trying to do something special because of the election, in my opinion, the plan wasn't set up based on the outcomes that you were seeking in the first place, because nobody's outcomes that they're seeking with their pile of money is, I hope to spend a bunch of it or to die specifically on the day of an election or right around an election. And so I want to time everything kind of based on that. It doesn't work that way. We don't live our lives that way. Does it affect us? Sure. But from a cash flow life perspective, everything kind of revolves around your specific family and the things that you're trying to get done. And so we want to be long-term investors. And so it is interesting to know. I hope, and it's also interesting, and I'm going to go there, and we're going to end here because maybe this get people come back next month. If you're on the left side of the aisle, that should give you some hope because you're like, hey, look, 14 for 4, for sure it's going to happen. Like, I already thought the market was going to be good because, I like everybody that's in office and I have a lot of hope for the future. If you're on the right side of the aisle and you think everything is doom and gloom and that our current president is kind of screwing everything up, maybe this gives you a little bit of hope for the simple fact that even if he does get reelected, it hasn't crashed the market yet. Not one time. So with that being said, Tim, great stuff. Interesting month.
Yeah, for sure. For sure. I think you're right. Yeah, no, it's always good to be with you. And not just because you complimented my haircut. No, that was nice. No, I like your broken record, right? Like, and at the risk of sort of getting too existential or too into, most folks have a record playing in their head, right? And sometimes they swap it out for another record. And as I get older and I've tried to figure some stuff out, it's really important, in my humble opinion, to have the right record playing, right? And there's a right record for your mindset, for your family, for your friends, and there's a right record for the market, right? So if you you want a broken record, right? But you just want to make sure it's the right broken record. And I think the way you talked about it, I mean, that's 100% the right broken record. Because unfortunately, a lot of people are playing the wrong record again and again and again, personally and financially, and you can end up in a really bad spot.
Yeah. Let me just give you one fun fact and see if I'm going to try to stump you, and then we'll end.
Okay.
Do you remember what happened on July 5th, 2022?
July 5th, 2022. So that's 2 years ago this summer, the day after 4th of July. I don't.
I would be shocked if that's an impossible question.
Okay.
It's the day the yield curve inverted.
Wow. Yeah. Wow. Yeah. No, that sounds about right.
And here we sit almost 2 years later. Have we had a recession? So my point is, like, there were people screaming at that moment, this precipitates a recession. This is what happens before a recession. And here we stand, you and I talking almost 2 years later about, hey, Jay Powell and the Fed might have figured this out. There's still a viable vision for a soft landing in spite of a piece of data that historically would tell you run for the hills.
Yeah.
So,
good point. Great point.
Why we stay in. You're going to invest. If you want to gamble, your odds are just as good as they are at a casino. Tim, great to see you in that wonderful hair of yours. Everybody, thanks for joining us for May's monthly market commentary. Again, I'm Brad Gatto. This is my buddy Tim Holland. Enjoy the rest of your month of May, and we will see all of you back in June.